Morning. Thanks for joining Thompson Hine's weekly coffee chat series. And I'd also like to thank you for returning this week after our unfortunate postponement of last week's session. So thank you very much for coming back. I'm Mike Wible, a partner in Thompson Hine's Investment Management Practice Group. This is our 24th webinar in our weekly coffee chat series. We design these as short and practical discussions that focus on a variety of developments that impact the financial services industry. Joining me today is Nobi Powell. Nobi is the Director of Asset Management Insurance for Mori, Donnelly & Parr, an insurance agent and broker. Nobi has been in the insurance business for over 30 years. Can you believe it, Nobi? Over 30 years. Nobi joined Mori, Donnelly & Parr in 2018 after 25 years at Willis Tower Watson. Today, Nobi and I will explore directors and officers and errors of omissions insurance, which is frequently referred to as DNO Insurance. This is a type of liability insurance that protects individuals against the financial impact of judgments, settlements, and legal defense costs that they may incur from shareholder lawsuits and other claims made against them relating to their professional services or their positions as directors and officers. So in today's coffee chat, we're going to cover a variety of topics. We're going to look at the difference between Side A and Side B coverage. We're going to look at joint insurance policies that cover both an investment advisor and a mutual fund. We'll talk about whether independent directors should have their own policies that are separate from the policies covering the fund and its officers. We'll look at how boards determine the appropriate level of insurance coverage. We'll talk about the importance of key definitions that you'll find in most insurance policies, such as claims and losses. We'll look at current trends in coverage and more importantly, what's currently excluded from coverage, because exclusions can change from year to year, and in particular in reaction to events in the market. And then finally, that perennial topic, we'll talk about whether it's necessary to have cybersecurity coverage. So that's a lot to cover, but I think we'll be able to do it all. And if you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box at the top of your control panel. As your questions come in, we'll take them if we can, and we'll also leave time at the end of the program for any additional questions. If we don't get to your question, please contact us, and we will take your question and respond to you after the program. Okay, so before we start, let's cover a few key concepts and terms, and by those terms are indemnification, D&O, and E&O, because these are very important terms to understand at the outset of this conversation, so the rest of it makes some sense to you. So let's start first with indemnification. A fund's declaration of trust and articles of incorporation generally allow independent directors to be indemnified for any legal expenses or other financial liabilities they may incur as defendants or non-party witnesses in fund-related regulatory investigations, regulatory proceedings, and civil litigation. And we'll just refer to those three things as legal and regulatory actions. So the term indemnification just means that the fund will reimburse the directors for legal expenses and losses that they incur in these legal and regulatory actions. And the reimbursement comes out of fund assets. So indemnification, in essence, is an independent director's first line of defense against personal financial exposure. A fund may also, under its declaration of trust or articles of incorporation, may also allow independent directors to receive advances to cover the legal expenses so that they are able to pay off the expenses as they go through the litigation or the investigation or any legal action, instead of waiting for the action to conclude and then receiving indemnification after the fact. So it helps out with those expenses if you're able to get the money in advance. So that, in a nutshell, is indemnification. Nobi, can you explain the difference between D&O coverage and E&O coverage?
Absolutely, Mike. Thank you. If I may, I'd like to capitalize on your insights and comments regarding indemnification, because it is imperative that our board members understand that, as you pointed out, indemnification is the first line of coverage and defense and has nothing to do with insurance. And then when we bring in the E&O, DNO insurance contracts, which, by the way, are not required by the SEC at all. Only the compliance fidelity bond is required from a regulatory perspective. But the E&O, DNO needs to be viewed as a funding mechanism for, as you just articulated, regarding the indemnification. So the women and gentlemen of these boards need to know first, as you point out, the indemnification provisions within the bylaws or managing membership agreement. And then it is the insurance contracts that serve as the funding mechanism. And going to your query, when we talk about trust boards within the 40 Act, we are dealing with unique fiduciary duty in that capacity. And as such, we use a blended E&O, DNO program, which covers E&O, errors and omissions, which is synonymous with professional liability and or fiduciary liability. And that is recognizing the professional services and the rendering of those services on behalf of the shareholders through the trust. And that E&O is uniquely different because it's third-party professional service, but because of the difference in the capacity of exposure by these board members, we blend in the DNO, which is, we know as directors and officers, as management liability. So we've got that management liability, duty of care, loyalty, et cetera, to the shareholders through the trust and the board. We blend those two together so we remove any ambiguity or potential gap in coverage for the trust board by blending the E&O with the DNO. Does that help at least start that conversation?
Yeah, that's great. Because that really illustrates sort of the how how insurance and indemnification work together. So the indemnification is that, like as we said before, the first line of defense. The E&O, DNO policy is the second line of defense to any exposure and liability. And we'll get into that a little bit later too, on why that's beneficial to the fund to have the policy. Even though it's beneficial to the fund and to the fund shareholders to have a E&O and DNO insurance policy, as Nobi mentioned, there is no legal requirement to do so. Unlike for those practicing in the fund industry, funds are required to have a fidelity bond. It's statutorily required. There is no statutory requirement to have insurance. However, today virtually all funds do have E&O, DNO policies because I think it'd be difficult to find a trustee or director who would be willing to serve on a board without the insurance coverage. And it also protects the fund, as we'll talk about a little bit later. So we talked about E&O. Well, the insurance cover. There's two types of E&O, DNO policies, and they're called Side A coverage and Side B coverage, and they cover different things and they're used for different purposes. Nobi, can you talk a little bit about Side A and Side B?
Absolutely, and Mike, again, it's a perfect segue because when our board members understand that their first line of defense is the indemnification, then the insurance contract is viewed as nothing more than a funding contract for that indemnification. Now you bring in the various sides of coverage within the coverage grants under an E&O, DNO joint or blended program, recognizing that it's how the insurance is going to reimburse the indemnification. So when we talk about Side A coverage, we really need to be thinking quite literally ABC. Side A is recognizing there are situations where the board members, the independent directors, those women and men may not be indemnified. Allegations of a personal conduct concern, like a dishonesty or fraud, where statutorily, as you pointed out, Mike, in that case, the bylaws are not allowed to indemnify. In those cases where the board is either not allowed to be indemnified or is simply being denied indemnification for whatever reason, Side A with the insurance contract steps in with first dollar defense, and there is no retention, which we might otherwise know as synonymous with deductible. But in a claims-made policy, these E&O, DNO policies, we retain the first dollar amount to typically pay for our legal expenses and our initial wave of protection. So side A is the coverage trigger mechanism when we're not going to be indemnified by the bylaws. And then we recognize side B, where those situations, in most cases, we are being indemnified through the bylaws within the trust structure. And when we are being indemnified, the insurance contract requires a retention to be paid. So side A, no retention. Side B, there's a retention that the fund or the trust would pay on behalf of the directors, and then the insurance company would kick in to reimburse for those legal defense costs and settlement expenses as you move forward. Side C is the final component, and that is when the trust entity or funds themselves are named, and that simply expands the protective blanket, if you will, over the entity trust itself by name. So now we've got protection for the individual board members, both interested and disinterested, and we have coverage for the entity trust itself. When we get into higher layers or dedicated layers, that's when we start to focus on just how to better protect the independent directors. Does that help give some insight, Mike, as to how those three coverages would play out?
Yeah, I think that's great, Nobi, and I think it's really helpful to illustrate two things. One, this is the side A covers those situations where there's no indemnification available from the fund, and side B, those situations where the fund has indemnified the trustees. I'm sorry, the directors or trustees, and the coverage is used to reimburse the fund for those expenses. And what it's really doing is reimbursing the shareholders, because the shareholders have paid the indemnification to the trustees, and now they're being reimbursed by the insurance policy. So side B really protects not only the independent directors, but also the fund and its shareholders.
Indeed. And Mike, if I may just add to that, because we talked about that before the presentation this morning, that most of the policies now for these 40 Act investment companies are providing dedicated excess limits embedded in the primary limit for the independent directors or disinterested trustees. So a hypothetical situation where the fund has afforded side A, B, and C with a $5 million limit, and then embedded on top of that within the policy is an additional dedicated $1 million just for the disinterested trustees. So at no time could the independent directors be left with no limit, having been exhausted or drained by otherwise unrealized exposure, where now the board or the independent directors are left with nothing. So these new dedicated excess policies are something that our listeners will want to make sure have been implemented in their own programs.
Yeah, and so Nobi, could you really briefly just talk about excess coverage and how, particularly with larger fund complex where you may have larger liability, larger insurance coverage or a greater amount of coverage, where you may have a group of carriers that are providing coverage at different layers of exposure?
Great question. So, Mike, basically there are capacity limitations within the reinsurance contracts that all insurance companies have to adhere to. Everybody is aware that while you've got a Travelers, Chubb, Hartford, whomever, they reinsure a lot of their exposure out the back door through reinsurance contracts. And those contracts of which we're speaking will put limitations on the primary carrier to say you're not allowed to take more than 10 million, as an example, in any individual tranche or segment within an exposure. So if the carriers are limited to 10 million per exposure or per layer, then as you point out, Mike, you have to create an excess layer program where you literally are stacking limits of 10 million to get to, as an example, a a larger fund complex that maybe is 100 billion or 150 billion in AUM. That policy, based on statistical norm, which we'll get to in a minute, may want to be carrying the better part of 60 or 80 million in limit. They do it with 6 to 8 different carriers, or in some cases, what they refer to as ventilation, where a carrier may write the first 10 million, they may come back 3 million later and write another 10 million on top of that 40. So they call that ventilation. So they'll come back and take another tranche or another group of 10 million and provide that. But that's how funds on the larger side are able to get or obtain the appropriate limits of coverage. And as Mike, I think you laid out in your agenda, we'll get to that question in a minute. But that essentially explains how excess layers, one, why they're necessary and how they're implemented. But keep in mind, we also can customize programs where those excess layers are dedicated just for the independent directors or just for the full board. So you can be very mindful on how you allocate your resources as you're purchasing insurance. But one footnote needs to be maintained, and that is making sure at no time does our fund board spend more money protecting themselves than they do the fund, the trust itself, i.e. the shareholders. So there's a fine balance there on how you allocate those limits within your program.
Yeah, thanks, Noby. And as Noby mentioned, insurance can get costly, particularly for a larger group, and as you're getting into those higher levels of coverage. Well, whether or not if you're large or not, when you get into those higher levels of coverage, it gets more expensive. So in some cases, it may be more cost effective for a fund to purchase a joint insurance policy that covers both the fund or say a trust and all the funds in the trust, as well as the fund's officers and directors, as well as the investment advisor. So these joint insurance policies are permissible as long as the fund complies with requirements in Section 17D1 under the Investment Company Act. Noby, do you want to briefly talk about what are some of the advantages and disadvantages of a joint policy?
Beautiful. Great. So yes, I'm a big fan, Mike, of Ben Franklin and sort of a pros and cons analysis. I'm always going to start with the negative. The downside is the fact that with a joint program, we are sharing our limit. And I'm going to speak from the perspective of a board member. So the board is recognizing the good and the bad, if you will, with sharing their limit with the advisor. The bad is because now the advisor is sharing in the board's limit. So if there is a situation where both entities, which is typically the norm, both entities are named in an allegation, both entities are feeding off one shared limit. In that situation, that would be the predominant negative or the downside. And there are ways you can put Band-Aids on that or remedy that problem. But I think the benefits outweigh the negative characteristics in that. The benefit is, first and foremost, the board knows the quality of the coverage that the advisor, that she or he has. So they know that that carrier is a quality carrier, and they know what type of limits and coverage grants are embedded within the policy because they're sharing it. Secondly, there is, as you pointed out, under 17D1D7, there's an allocation of premium that's required by the SEC to make sure that the premium allocation is fair and reasonable. Well, the beauty is we're automatically in compliance because through the sharing of the program, specifically the limit, there is a 20 to 25% discount afforded both the advisor and the board, the trust, for sharing their limit. And then the third item, and for me, from much more of a pragmatic perspective, because you need to make sure your broker serves as your claims advocate. When I have the policy, the coverage, for the board and the advisor with the same carrier, in this case, the example we're using is the same carrier and the same policy. But when it's with the same carrier, the policy creates more of a facilitated approach to a claim because we don't have one insurance company's lawyers in their claims department arguing with another insurance company's lawyers in the claims department as to which policy is primary. If they're both with the same carrier, it serves to expedite the processing of the claim. And unlike any other profession, we have to disclose every issue to the SEC. We want to get these matters addressed and resolved and removed as soon as possible. And having that joint program, going to your point, Mike, serves to facilitate that. So that would be the negative, I think, is outweighed by the positive impact. And again, as I mentioned a moment ago, Mike, we can creatively create within that positive impact dedicated limits so no one entity could drain coverage from another.
Yeah, yeah, and even if the carrier doesn't or the broker doesn't create dedicated limits for you, a fund internally with its investment advisor could enter into an agreement where they're going to allocate access to coverage or the amount of coverage that's available to each party, so that the advisor doesn't drain all the coverage before it's available to the fund. And you know what, Nobi, it just occurred to me as we're talking about this, and you mentioned earlier a claims paid policy. Could you, and because we're getting close to the end of our time, just really briefly, very shortly explain what claims paid policy means, and the fact that with each year there's only so much coverage available to the fund, right? So that one party or the other in a joint policy situation can deplete it to the detriment of the other.
Indeed. And the claims made versus occurrence form policies, we know the occurrence form, the latter scenario, by our homeowners or auto, where it's the policy will pay out that is on the risk at the time that the loss occurred, where a claims made policy pays out on when the claim is made, not necessarily on when the policy or when the when the loss occurred. So a claims made, so we could have had, I'll use a regulatory issue. We could have had a problem with the SEC 2 years ago, and we hear about it today. It is the policy today when the claim is made that will be triggered for that type of exposure. So that, a very basic overview of how those policies work. And in terms of the structure of the policy programs, you make a great point that you can create limits, allocations internally as it relates to coverage. As it relates to limits, the insurance companies are only going to see first come, first serve. So your observation and recommendation to your clients is spot on how to do it. If we wanted to be more formal in that and outside of crafting language within the advisory agreement, you can create separate towers, is the expression, Mike, they use in the industry, which is really nothing more than a dedicated limit or sublimit for each entity. In other words, you can put a $10 million aggregate program for a blended and shared with the board, the trust, and the advisor, but say to the advisor, you have a 5 million sublimit. So only can the board, only can the advisor access the 5 million, and then the board would have automatically the other 5 million and the additional 1 million that's embedded in the program for the independent director. So we can be very creative, going to your point, Mike, on how you structure that in terms of allocation.
All right. Yeah. Thank you for that. The other thing about about joint policy is that Section 17D1 requires that the premiums be allocated between the fund and the advisor, and the portion that the fund pays has to be its proportionate share of the premiums that it would have paid had it purchased the insurance policy on its own. And brokers like Nobi would be able to advise a board on what the amount of premium would be in those situations. I'd like to move on to the amount of coverage and determining amount of coverage, because as fiduciaries, boards are perennially struggling with trying to determine the appropriate level of coverage. The directors want to make sure that they're fully covered, but they also don't want to pay more in premiums than is absolutely necessary. So Nobi, and I know you advise boards on this all the time. How does a board figure out the appropriate level of coverage?
A great question, Mike, in that we want to be very mindful of, as you just articulated, the fiduciary duty that the board has. So anytime we can assist them with statistical data and actuarial information as it relates to specific types of claims, and then as you point out, what is the an appropriate limit? Well, what we do is we create essentially a compilation of data. John Mulligan, who's the executive director of underwriting for the Investment Company Institute, which you may know is a captive risk retention group down in DC, designed specifically for the 40 Act investment company world. And they represent probably the largest investment companies in the world. Well, I blend out of my 300, give or take, advisors and funds based on their AUM, combine it with what John does with his operations, and we come up with a range of limit based on AUM. So an example would be, and again, this is statistical data, which I'm happy to share through you, Mike, but as an example, a fund complex between 1 and 5 billion in AUM, their respective peer group purchases between 5 and 10 million. Keeping in mind this is subjective, but as you point out, Mike, it does give the board some parameters, and they know that they can be on the high side or the low side, but they're still within those parameters, if you will, of what would be otherwise considered reasonable. So it addresses their fiduciary duty in making sure they're securing the right limit. And as you pointed out, we're not just handing all our money over to the insurance company by thinking more limit is better. We can come up with a reasonable explanation as to why we secured that limit.
Yeah. Okay. That's great information, because if you can give the range of coverage within a certain asset range, the board then can also take into consideration the types of funds that are in the trust, the investment strategies they're pursuing, the shareholder base, other factors like that, to sort of figure out what their risk appetite might be, or their potential liability could be if there's a litigation or regulatory action taken against them.
Right, and
let's
great
go on.
point quickly that you make, in that there's no deviation or acknowledgement from the norm based on strategy, whether it's fixed income, equity, commodities, ETF structure. It's just blended all together, so it just gives you that broad range from which to pick.
Okay. So let's do some talk about some defined terms. Anybody who's read an insurance policy knows that they're really difficult and dense documents to read, and they have a lot of defined terms, like claim, loss, wrongful acts. Nobi, what's the importance of understanding exactly what these mean, and what could happen if you don't understand what they mean?
Okay, great. Well, definitions of claim, what I like to do, try to keep this straightforward, is create some methodology in our understanding or interpretation. So if what we want to do is look, as you pointed out, claim, loss, and wrongful act, and look at it in terms of hierarchy, in that the wrongful act, based on the nature of the allegations, is it a breach of fiduciary duty, negligence, failure to adhere to guidelines and strategy, or even a transactional loss in some cases? That's defined based on the contract. So you receive an allegation, look at wrongful act and make sure it meets that definition. And then it goes to, from wrongful act, it goes to claim. And the definition of claim is what essentially is going to trigger coverage. Most policies, as you noted in your notes too, Mike, that they removed coverage for any investigation language. When I started 30 years ago, 25 years ago, any investigation language was the norm. The ICI, the captive mutual, is one of the few now that give you that option right from the beginning of formal investigation versus informal, or any investigation. Most of the commercial markets now require the norm is formal investigation language, and then you can endorse or buy back coverage for broader, such as informal investigation. But the claim is going to be the item that triggers the coverage, and then the loss is what's determined on what the insurance companies will pay you and what constitutes a loss in terms of what you're legally liable to pay. versus what they're not going to pay. For example, and I think, Mike, you brought it up earlier, the insurance companies do not see a loss as a tax or a penalty or disgorgement. None of that qualifies as a loss, and they will not reimburse us for that. That's really typically when we're dealing with a regulatory authority, where a settlement with that authority is viewed as a penalty or a fine. The insurance companies will indemnify us for our legal expenses, but they will segregate out those expenses related to any settlement, i.e. tax or fine, with a regulator and say we're not paying it. So it's key to know, as you point out, Mike, those definitions and how they trigger the coverage. There are abilities now to get informal language because the insurance companies do not define the term formal investigative order. So what the informal does, it's something a board to consider or look into, is acknowledging what a formal investigation is not. And it's not an SEC exam or a routine, obviously an SEC routine exam, information sweep, inquiry, or inspection. Those items are not considered formal investigations. So making sure you work to have coverage triggered as easily as possible is one of your goals as you review these insurance contracts.
Yeah, that's a very good point, and that takes us to our next point, which is coverage trends in coverage and exclusions. And back to Novi's point, it's important through an endorsement or other to have, for instance, cost of informal investigations or settlements and maybe settlements isn't, I think, cost of investigations, cost of corrections, things like that covered, because most disputes and other actions in the place where a lot of expense is incurred are not necessarily an enforcement action, but dealing with the SEC or other regulators or a third-party litigant in before any formal action is taken, right? So you do incur a lot of expenses there, which it would be nice to be reimbursed for. So that brings us to trends in coverage and exclusions. And Novi, you mentioned that ICI Mutual does provide informal investigations coverage, and you can add other things through endorsements with other carriers. What are you seeing as in the industry in terms of those types of new types of coverages?
Well, as you just mentioned, Mike, and the ICI does give you that option right away. And this is fairly new within the last 5 years, that they come out with their options for your consideration, board's consideration, and say, do you want formal investigations coverage, or do you want informal, a more relaxed approach? But getting to that issue, you would always want to be able to trigger coverage as early as you can. And the problem we have with the insurance companies is that nothing happens until their claims department says it is now a covered cause of loss, i.e. it is a claim. Well, the problem is it could have taken them months to make that decision, while the board has incurred tens of thousands legal defense going back and forth with our regulatory authorities or with enforcement. And in those cases, those expenses that we've incurred, the insurance companies don't even consider that part of your expense until they deem it a claim, a covered cause of loss. And at that point in time, they make you start anew, where you may have already incurred 40 or 50,000 in legal defense. So you want to make sure that within your policy, you have what's called a pre-claim expense endorsement, which means that the minute we get a deficiency letter, as a hypothetical example, from the SEC, we take that deficiency letter, we send it to the insurance company as a notice of circumstance, and as that point forward, if we incur any legal expenses before they deem it a claim, then once they deem it a claim, we get to go back retroactively in time and use all those legal expenses to offset our retention. Unfortunately, the reality is if that item never becomes a claim, that's simply money we've had to spend as a cost of doing business. But we definitely want to seek triggering informal investigations language, as we mentioned a moment ago. We want pre-claim expense in there. We also like to have cost of corrections for the advisor for transactional areas, a fat finger trade or a buy sell flip flop, because this way, as you noted earlier, Mike, this is a trigger mechanism under legal liability. In these transactional areas, we simply want to make the position whole and move on. We don't want to have to create legal liability. So this removes the problem of having to put somebody on a third-party notice. The advisor can notify the board that there's been a transactional loss, and the board says, well, make the fund whole. And the advisor can then notify me and the insurance company in like kind, and will allow us through that coverage to trigger it under a first party, meaning within our family. And then we make the position whole, then we report the SEC and the shareholders that we've remedied the problem. Cost of corrections is for the advisor. I've seen some large fund complexes buy cost of corrections for themselves. But the problem is, I think it's a misunderstanding because the insurance companies are not intending to let us use cost of corrections for any type of valuation issues, which we might otherwise consider a transactional loss. I have had nothing but uphill battles over the years with the carriers with those types of valuation issues. And I've gotten to the point where I just recommending to the board, do not think that cost of corrections is going to help us there. If there's a valuation issue, unfortunately, we need to wait for someone to trigger under a third-party notice. So those are some highlights. I'm sorry, Mike, go ahead.
Yeah, no, I was just saying, Nobi, I think you're taking us exactly to our next point, actually, with when you talked about cost of insurance and the cost of corrections, I mean, and that it's really appropriately a coverage for the advisor, because that's where actually most of the activity had taken place, right, where the transactional error had occurred. So that brings us to cybersecurity coverage, and it's a perennial discussion at board meetings whether you need cybersecurity coverage and whether it's appropriate for the fund or the service providers to have that coverage. So what is your thought on that?
Great question. And really, to this point, we are not seeing any fund boards securing their own dedicated coverage. They may have some, like a marketing little, someone's add network security in under their E&O, DNO, but it's really fluff. A true standalone cybersecurity, cyber liability policy is for the benefit of the advisor, fund administrator, and those service providers that are involved with transactional exposure where a cyber breach could affect the outcome. When we're dealing with a board, we're really dealing with a vicarious, at best, exposure. That indirect exposure, if we were sued for alleged breach of fiduciary duty for failing to prevent a cyber breach or event, the current E&O, DNO policy that they have in play should have no exclusionary language in that regard. So they would have coverage there for that type of third-party allegation. But again, that's pretty far-fetched in terms of trying to blame the board or simply name the board as a deep pocket in that type of allegation, where cyber is really, as you pointed out, Mike, should be focused on the service providers who have that type of transactional exposure, who could be subject to ransomware, some type of loss of income or business interruption. And that's where those cyber policies are most appropriately secured. Okay,
great. Thank you. Well, we are out of time. Actually, we went over time, but it's a great conversation with Nobi. So thank you for that. That includes today's chat. If you have any comments, please enter them in the Q&A box now. Our coffee chats are taking a break for this summer, but please join us again in the fall. We'll have more exciting topics. Thank you for joining us weekly over the past 6 months. We've really enjoyed putting these coffee chats out to our audience, and the questions and responses that we've gotten have been great. If you missed a past coffee chat, we encourage you to view our library of recordings, which are available on Thompson Hine's YouTube channel. We want to thank you again for attending today's program, and thank you very much, Nobi, for joining us and sharing your insights. Working with a broker like Nobi is a great resource for fund complex and an investment advisor. he and his fellow brokers can give a lot of information and to clients about the appropriate level of insurance, the type of insurance, and act as an intermediary with the insurance carrier. So great service that you provide, and thank you again for joining us, Novi.
My pleasure. Thank you.
When the webinar ends, you'll be prompted to take a survey providing feedback. This feedback is very important to us to help us continue to tailor our programs to your needs. Thank you again for joining us. Enjoy the rest of the day and stay well. Bye.
Thanks everyone. Bye-bye.